Hello traders, welcome back to Nova's channel. And in today's video, I will introduce to you the fair value lookup trading guide. Let's get started. First, let's find out what is fair value lookup. A FVG is a switch movement in price, visible with three candlesticks where the middle candlestick is strong and impulsive, creating a price zone that does not overlap with the first and last candle. This means that when looking for a fair value gap, we are not just observing the closing price, but also where the wicks of the first and third candle are in relation to the second candle. If the wicks are large, then it's likely no gap is formed in between the candles. The concept of fair value gaps comes from a modern trading approach called smart money concepts. Traders use this approach to anticipate how smart money, the big players with substantial trading volume, intend to move the market. FVG signal is significant market move, likely driven by smart money rather than averaging retail trader, and they often indicate strength in the direction of the gap. If a FVG forms at a price rise, it suggests a bullish bias. On the other hand, if it forms at a price drops, it signals a bearish bias, as smart money may be pushing price lower. At its core, a fair value gap is like a bucket of unfilled orders in the market. It acts like a market gap where the price moves so fast that not all orders get filled within that zone. This is called an imbalance. Traders believe that when the price revisits the FVG, those unfilled orders will get triggered, leading to a potential price reaction. Think of it like reading through a book too quickly. Eventually, you'll realize that you missed some important details. So you flip back into those gaps of information, just like how the market revisits an FVG to fill unfilled orders. And there is also a note here. Fair value gaps do not always result in a price reaction and only signals a high probability for one. When a reaction does occur, its strength depends on the type of FVG form and how is it aligned with the market's overall trend. And next, we will explore the reason why it caused a fair value gap. A fair value gap forms when rapid buying or selling creates a dramatic three-candle structure on the chart. This swift price change is often attributed to the smart money injecting large volumes into the market. Therefore, should the FVG be revisited, smart money could theoretically step in and protect their buy or sell positions at the price zones. Economic news or fundamental events can also be another factor in creating fair value gaps, as they can entice large orders to come into the markets, especially if the news announcement goes against the market expectations. Major economic news, such as inflation data, interest rate decisions, and employment data, can often give insights into how well an economy will perform in the future. While most news will not move in the market significantly, surprising news will. For example, if 90% of the market was expecting a rate hold, but the news of a rate cut was happening instead, it would cause traders and large institutions to quickly adjust the positions, causing a sudden flux of high trading volume. For individual stocks or other assets, earnings reports can create sudden price movements if the report figures, like revenue, profit, guidance, differ sharply from forecasts. If institutional investors react quickly, the market may form an FVG. And the next is going to be relating to market sentiment. Shifts in the market sentiment, driven by risk appetite, geopolitical events, or central bank statements can lead to aggressive buying or selling. If this shift happens suddenly, price moves away too quickly to efficiently fill orders, leaving a behind fair value gap. Besides, when demand far outweighs supplies, or vice versa, price moves swiftly as buyers or sellers scramble to execute the trades. This often occurs when liquidity is thin, such as during the market open, especially on the Monday's Asian session. After major announcements or in trending markets with minimal retracements, big players such as hedge funds and banks execute large orders that may not be fully absorbed by the market at once. This bulk transaction can push price sharply in one direction, leaving a gap where liquidity was insufficient to provide a smoother transition. Besides that, a fair value gap can be a bullish or bearish, depending on where it falls relative to the price. When the price is above the fair value gaps as it formed, is it a bullish FVG? On the other hand, when it's below as it formed, it's a bearish. And now I will show you what is the bullish fair value gap. A bullish fair value gaps are formed when the price moves higher impulsively, creating the pattern in the process. This one is established as the secret support zone, where price may revisit and potentially bounce. In fair value gap trading, the term mitigations refers to whether an FVG has been revisited. A fully mitigated FVGs mean the price has filled imbalance, reducing its reliability as a reaction zone for future retests. A partially mitigated FVGs means the price has tapped into the gap but not fully filled it, meaning it may still provide a reaction. And lastly, we were talking about unmitigated FVG. It means the price has not yet returned to the gap, keeping it flat for a potential first reaction. Since an FVG represents a cluster of active orders, a fully mitigated FVG means that the orders have already been triggered, making the FVG no longer valid as reliable support. Below here is 4 types of bullish fair value gaps, each with different information and meaning. First, we will talk about perfect fair value gap. A bullish perfect fair value gap is formed when the third candle is a small bullish consolidation candle. Note that the candle low is not below the previous candle's closing price, validating as a bullish PFG. This implies a high chance for the fair value gap to be revisited in the immediate term, giving us a chance to enter a long position. And the next pattern I will introduce to you today is a breakaway fair value gap. A bullish breakaway fair value gap, or BFG, is formed when the third candle is a large, expansive candle. The third candle's close in a BFG setup reflects a strong directional momentum. Its size and wick can help validate the strength of the move. Aggressive traders may consider entering a long position directly at the formation of this pattern, as price is unlikely to retrace in the short term. And the next pattern is about the rejection fair value gap. A bullish rejection fair value gap, or RFG, is formed when the third candle closes into the second candle. This implies weakening momentum and signals a weaker fair value gap that is unlikely to hold as support. And the last pattern of bullish FVGs is about inverse fair value gap. Additionally, inverse fair value gap often forms alongside another fair value gap, creating overlapping zone. This overlaps acts like a key areas of interest, offering traders a powerful zone to watch for a potential bounce. And in the next video, we will continue for the bearish fair value gap. Thank you for watching and see you in the next video.